Hey y'all, Zach McDonald, your real estate agent at Real Property Associates. And today, I want to answer the question, do you need to put 20% down on your mortgage? This is a common question for specifically first-time home buyers, but I get this from buyers just in general, wondering what their minimum required down payment is. And a lot of times that idea of 20% is kind of in their head. It's sometimes a roadblock, and I don't want it to be a roadblock for you, If you're an investor, the answer to this question is going to be different. The answer is yes. If you're an investor, generally the bank is going to want to see a 25% down payment. Without getting into too much detail, it's mainly there's going to be more risk for them lending to you as an investor, and they want to see more upfront from you. Now, if you're a homeowner or a buyer looking to purchase owner occupied, there is a lot of loan programs available to you. So without listing off all of the loan programs, as I'm not a mortgage broker, I'm a real estate agent, I want to just share with you, you could put 5% down. You could put 10% down, 15% down. Essentially, you can put whatever down you want. They even have zero down programs again. The majority of my clients are probably somewhere between 3 to 20%, right? So there's a 3% conforming loan program. There's a 5% program, 10%. I actually put 10% down on my own home purchase. The reason that people think of this 20% number is actually mainly because when you put less than 20% down on your mortgage, the majority of loan programs will charge you what's called mortgage insurance. And this is something that you'll pay either monthly or you can do a one-time premium. It's something that will be, it really depends on your situation, $100, $150 roughly a month extra on your payment. You get your principal, interest, taxes, and insurance kind of all wrapped up into one, and then they'll also add on the mortgage insurance in addition. So if you're putting over 20%, you won't be paying that. If you're putting less, you are paying that. It's something that you can, after a couple years, if your home's appraised for more than what you bought it for, and it's kind of made up that difference in the 20% number, you can get that taken off. So it's not something that's there forever, but it is there at least for the beginning of your loan term. So for some buyers, that's more of a big deal than others. Honestly, I have mortgage insurance on my own house. It's not a huge deal. If you think about it, it's a little over $1,000 a year for the first couple years, and then you can take it off. And that gives you the opportunity to get your foot into the market. And I can tell you that my house has appreciated more than $1,000 a year over the last year, even since we bought. So I hope this is helpful. If you have other questions about loans in general or getting qualified to purchase a house, happy to talk. I've also got some great connections with local lenders that I highly recommend, and they'd be even better resource in this category. So thanks for watching. Again, I love your comments down below, and I love to hear from you. And if you have other questions that are real estate related, I'd love to take a moment and answer those for you as well. Until next time, bye for now.